in the middle of COVID-19 crisis, flooding economies with money is in a way giving impression that central banks are, so to say, saving the world. Is this true or just an illusion? Because there have been reports the money creation has not been trickling down to the struggling real sector.
Yes, that of course is an important question. Is the money reaching those who need the money and also who would use it in a productive way that contributes to society and is sustainable? Because ultimately we're talking about loans, sustainable meaning that they can be serviced and repaid without, distress or any problems like that. And these are difficult conditions to meet. And so you can already tell the likelihood is, perhaps not. But the other point you raised, the other question you asked was, so are the central banks saviors of the economy? Well, when you said that, I had this image of, this fire, a big fire taking place, and the fire engines are arriving, and the firemen, get going, and they're the heroes rescuing the day. But actually, in quite a few cases, it's been shown, well, in rare cases, let's say, but there have been cases where, it's this fireman syndrome, where there hadn't been any fires, and they feel a bit sort of underutilized, and they feel not celebrated enough as heroes. And it turns out that one of the firemen set the fire. Okay, hopefully these are exceptional cases. But when it comes to central banks, then perhaps we do suffer a little bit from that phenomenon, because, a bit more than a little bit, because the problems that central banks have to deal with are usually of their own making. Who's created the situations in the first place? Now, you could argue 2020, okay, there's other events happening, and there's government decisions which is separate from central banks. Fine, fair enough. But we also know that a lot of the stress in the financial system had already been building up beforehand. And then with the government restrictions, many things were just accelerated or triggered, but the underlying problems already were building up. And so I suppose we should be talking a little bit about those and how they came about, and who has responsibility for that. But I think it's fair to say that the central planners at the central banks will probably feature in that analysis.
Mm-hmm. Back in my first year at economic faculty, we were taught money is being created by central banks, and that interest rate movements determine growth rates in the negative correlation. You have measured it thoroughly and concluded this is all wrong.
I'm sorry.
It seems like quite a few monetary policy principles should better be ditched.
Exactly. Yes, indeed. In fact, you mentioned the two of the very cherished alleged truths on which a lot of the economics establishment and also the central banks have been building their activities and their policies, and the entire edifice of modern economic policy making seems to be built on this, when actually it doesn't stand. The pillars have crumbled. Perhaps we start with the interest rate story, because it's famous that economists always have different opinions and they always quarrel and argue. But actually, there was one area where all these economic schools of thought and economists from so many different approaches seem to agree. In fact, I went back to, more than 200 years ago. The classical economists, David Ricardo and his colleagues, they already argued, lower rates will lead to higher economic growth because it leads to more investment, more economic activity. Yeah. And, it stands to reason. It's a reasonable argument. And then, of course, after that, the more modern versions, the neoclassical economists under Alfred Marshall, this is already also over 100 years ago, they said, yes, that's a valid relationship, which we should keep in mind and use for policy. And then there was a bit of a backlash. The Keynesians were criticizing these models, but they agreed on this point that no, actually, yeah, lowering rates is the way to stimulate the economy. And if you want to slow it, you better raise rates, interest rates. And then after the Keynesians, there was this big debate with the monetarists. And the monetarists, they were talking more about the quantity of money, but they were not saying that's the only variable. They agreed that, well, of course, there's the price of money. That's also important. And how does that work? Well, lower rates lead to higher growth, and higher rates lead to lower growth. And then after the monetarists, we had the essentially then all the quantity variables were dropped because they weren't working out the way they had predicted, money supply, and then they argued this is the new classical economics from the 1980s onwards and has become dominant until this day. It's been arguing that, well, it's really we should focus only on interest rates. That's really what's working. And how does it work? Well, what do central banks need to do? They move interest rates, lower rates lead to higher growth, higher rates lead to lower growth. So it's really across all schools, even some unorthodox schools like Austrian economics, the Austrian economists. There's a lot in America, more than in Austria, I suppose, these days. But, they're very free market and deregulation oriented. They are critical of central banks, but on this point, they entirely agree. So really, we have a very rare case of a complete consensus of both the establishment economics and even a lot of the critical alternative voices all agreeing on this one thing. And on top of that, we have the policy makers themselves, the central banks and those involved with central banking, coming out almost on a daily basis, reinforcing this argument that, if you want to stimulate the economy, you lower rates. And now, well, already in the last few years, but again, in 2020, it's a big topic. Why? The Bank of England has now come out and said to the banks, in fact, this is an informal letter to the banks, but it was leaked to the newspapers, so we've heard about it. It's asked all the banks in the UK, if we lower rates further, namely into negative territory, what are you going to do? Are you prepared for this? What are your preparations? So the central bankers are talking about negative rates now, so lower rates even further and even further into negative territory. Of course, this has already happened in the Eurozone, as you know. We've got negative rates there between the central bank and the banks. In Japan, we've got negative rates, in Switzerland, in several Scandinavian countries. So it's quite a lot of countries where we've had for several years now negative rates. And why? How did we get here? Well, central banks used the logic that by lowering rates, we stimulate the economy. And because they'd lowered them already so many times from, 20 years ago, in most countries, we had well above, 6-7% interest rates in most countries, and lowered them and lowered them and lowered them. In Japan, 30 years ago, in 1991, we had 8% interest rates. And in fact, Japan was a pioneer in this, which is why I had a bit of an edge in the analysis of what's going on in the world, because it seems that Japan was the experimental test case where a lot of this stuff was already tried a decade or more earlier. So in Japan in 91, interest rates were 7-8%, and the economy was slowing, and the central bank said, well, we need to lower rates. So they lowered rates, but the economy was not being stimulated. It didn't happen. What's the solution? Well, obviously, we need to lower rates more. So they lowered rates more, and they kept lowering for a whole decade. 12 times they lowered rates, lower. Oh, they're approaching zero. Well, never mind. Let's lower them to zero. So then we had zero interest rate policy. Oh, it's still not working. The economy is not accelerating. Well, then we need to. Well, that took a while, actually, in Japan, that they actually pushed them into negative territory. There was a lot of resistance against it. Well, we should talk about why that is. But in the end, they also did that. Now, throughout this, it did not achieve the goal that people set out to achieve with this. So that's already one mind-boggling thing. You know the definition by Albert Einstein. I mean, I never checked it, but he's allegedly said and is always quoted and attributed to him, that he said the definition of insanity is if you keep doing the same thing, but you expect different outcomes.
Yeah.
Like if something is not working and you keep doing it, but you expect next time it's going to work. Oh, it didn't work. Well, next time, let's keep doing it. Keep doing it. Allegedly, he said that's his definition of insanity.
Mm-hmm.
Well, I just leave that quote here because essentially there seems to have been a lot of repetition of the same attempt to stimulate the economy by lowering rates even into negative territory, which is now the debate in some countries where this has not yet happened, like the US and the UK, when it's quite clear that this hasn't really worked. It hasn't worked for Japan in the last 30 years, and it hasn't really worked for those countries that have embarked on lowering rates. And so I decided, well, let's just step back, and particularly from the post-2008 situation, because you could always argue, okay, that's an unusual situation with a huge
Yeah.
banking crisis. A lot of things changed, you could argue.
Mm-hmm.
You could argue the same for 2020. But let's step away from that. Let's look at a long-term data series just before 2008, and let's look at half a century. And let's look at the key economies where you can't say, well, that's a special case. Japan is weird. That's, well, actually, Japan is the, third or fourth largest economy, depending whether you measure by purchasing power parity or not. But, it's one of the top five. And in fact, I took the US, Japan, Germany, and the UK, who for most of this half century were in the top five economies, or close to top five with the UK, you could argue, but clearly, important economies for the world economy. And I just wanted to test empirically what is the empirical relationship between interest rates and economic growth. They always keep repeating this, that lower rates lead to higher growth, but is this really true? What's the empirical evidence? The first surprise was that there weren't any studies on this. And for something that's being repeated for 200 years since David Ricardo, so self-confidently, it is a bit of a shock when you then realize, wow, there's just the emperor's without clothes. There's no empirical evidence for this published. But surely maybe it's because the data is so clearly saying this that you don't even need a study on it because everyone can see it. So, okay, let's do the study. So I did the study on this. And there's two dimensions to it. One is the negative correlation. Lower rates and higher growth should be correlated. Higher rates, lower growth. So that's called a negative correlation because they're inverse. Mm-hmm. One is low, the other one is high, and so on. It's inverse relationship. The other dimension is the causation. Of course, with statistics, with data, you can't, it's not possible to get to true causation. You can only look at statistical causation, which is fair enough. It's close enough. So what does the statistical causation say? This is called range of causality. It's essentially the ability to predict one variable with another variable. Yeah. Predictability. What's the predictive power in one series compared to the other series? Okay, so I did this study with a colleague who's now at the Central Bank of Luxembourg, a central bank researcher, and the conclusion is there is no negative correlation. So when interest rates go down, this is not correlated. This is not associated with higher economic growth. There is no empirical evidence for this. Okay. In fact, to be very strict on this analysis, we decided, well, the data has to tell us what's the correct lead or lag time, because you could say, oh, you're looking at the coincidental data, but maybe there's a lag time for policy to work. Fine, yes, let's check for that. Maybe there's a lead time. Fine, let's check for that. So this is called dynamic conditional correlation, where the data tells you what is the optimal lag or lead time. And it's an open-ended question. What does the data say? Conclusion is, for these four countries, for short rates and for long rates, very clear result, couldn't be clearer. The correlation is positive. So interest rates and economic growth are positively correlated. So this means if you want higher growth, you need a scenario where interest rates are rising, higher rates associated with higher growth. Lower rates are associated with lower growth. That's an empirical fact, which for some reason, all these people talking about how we need to lower rates and use interest rates as policy variable, they don't seem to either be aware of, or they refuse to admit, or to refuse to talk about. The other dimension then is the causation. And of course, the argument clearly is that we move rates in order to achieve something, so that there must be some kind of explanatory power of rates, some causal effect of rates on the other variable, economic growth, investment. And that seems quite reasonable, that if you have more investment, you get more growth, and what stimulates investment will lower rates. So, the old story had some logic to it. But what we found is that it doesn't stack up. There's no empirical evidence also on this second part. The causation doesn't run from interest rates to economic growth. There is more evidence for the opposite causation, from economic growth to interest rates. Namely, when there's more economic growth, because they're positively correlated as we established, this means this will cause rates to rise. And so instead of the official story, lower rates lead to higher growth, and higher rates lead to lower growth, we have the empirical reality of higher growth leads to higher rates, and lower growth leads to lower rates.
Mm-hmm.
Which means you cannot use interest rates, certainly the way it's been described in the simplistic way, for proper monetary policy. And therefore also by lowering rates further, you can't expect a recovery. This is why it hasn't worked for so long. When we lower rates and lower rates, that doesn't lead to a recovery. And also lowering rates into negative territory doesn't lead to a recovery. There's no empirical evidence for that. And we should perhaps talk a little bit more about negative rates, because that's of course a very unusual scenario, and it has some very explosive and dangerous properties. But the myth is now has been busted. Interest rates work differently. They follow growth. They're positively correlated to growth, and therefore lowering rates is not what we need for an economic recovery.
Have the creators of the monetary policy acknowledged that publicly yet, or not yet, really?
No, they haven't. They haven't. In fact, you see still the statements by the policymakers that if there's economic weakness, well, we need to lower rates.
Mm-hmm.
And so just this month, the Bank of England writing to the banks, are you prepared for negative rates? Which is, why they're asking this, because they want to lower rates. Why do they want to lower rates? I think it's because of the official story that lower rates somehow stimulate the economy. But there's no evidence for that.
What did the British banks say back?
Well, that's not reported.
Uh-huh.
Perhaps they haven't responded. This is fairly recent.
Uh-huh.
And I suspect maybe they haven't reported. There probably is a deadline, and they probably want to do this properly, so it will take a while. But I don't know whether we get leaks from their responses.
Mm-hmm.
I suspect some will want to give the impression to the bank regulator, because the Bank of England is also the bank regulator, that they are, they're strong, and therefore, yes, we're going to be fine with this. We're going to be ready for this. But I think really they should write back to them and say that, look, we're not prepared for this, and we're not going to be prepared for this, because this is a bad policy which will hurt the economy, and we believe you're a good regulator and you will take smart policies and not bad policies. That would be, I think, an appropriate answer. And then, of course, they should give the empirical evidence and the logic.
Mm-hmm.
And the reason why negative rates are so explosive and so dangerous is because, well, first of all, I mean, let's actually, again, let's look at the empirical facts. We have several countries where there's negative rates. The first one, or one of the first one, was Switzerland. And I've been essentially a year or so after they introduced negative rates, which is already several years back now. I think it's almost 5 years ago. there was this conference among bankers, and I was invited, and there was a banker from Switzerland reporting about this, and there was, great interest, like, tell us what's happening with these negative rates. And he said that, well, if the goal of the policy was to make borrowing money for, for companies for investment cheaper, which might be logical, if that maybe is a reason behind this, then the policy has failed. Why? Because actually, as they lowered rates into negative territory, the interest rates at which the banks lent to companies went up. And why is that? Because how and where is this negative interest rate being charged? It is imposed by the central bank on the banks, namely on the money that the banks are holding with the central bank. These are called the reserves.
Yeah.
It's the bank's reserves at the central bank. And one logic in this argument why central banks should have negative rates is that with that they can sort of punish the banks for holding reserves at the central bank. The banks then have to pay a punishment fee, like a tax, the negative interest rate.
And then they transfer it to.
And therefore they will then all say, well, let's pull out this money and lend it to the economy instead of holding it as a central bank.
Yeah.
Well, this is a complete misunderstanding. This is wrong. This analysis is plain wrong. This cannot happen. It is true that one individual bank may succeed in reducing its reserves at the central bank. But it can do this only if it increases another bank's reserves at the central bank. Why? This is a closed loop. It's special money. It's not normal money. It never circulates in the economy. And how did this money come about? It's entirely due to the central bank's action. So the amount of reserves that the banks are holding at the central bank is completely determined by the central bank in aggregate, not individually by bank. That depends on banks' behavior towards each other and so on. But in aggregate, the aggregate amount is determined by the central bank. And the central banks, through their application of what they call QE, quantitative easing, they ended up increasing the bank's reserves at the central bank. And that creates this wrong impression in the public that the banks are now, they're taking money from the economy and putting it at the central bank instead of lending it out. But that is not the situation, because the money that banks lend out never comes from central bank reserves. And that's the other point, and this is how the two topics are linked. You mentioned in your earlier question my empirical test of where money comes from and whether banks are financial intermediaries or what are banks. And
that's what we were taught.
Exactly. Well, I'm professor of banking, and I've also, before becoming professor of banking, studied banking, and so I realized that there's actually three theories of banking. And the one that's currently dominant, the one that you learned, is banks are financial intermediaries. They gather deposits, and they then do their analysis of borrowers, and then they lend out these deposits based on their analysis and risk management and whatever. But there's an older theory which was dominant until the 1960s, and this is known as the fractional reserve theory of banking.
Yeah.
And this one says that, similar to the financial intermediation theory, it says that, yes, each individual bank is a financial intermediary, just as you heard. They gather deposits, they lend it out. But in aggregate, there's something happening in the banking system collectively. As the banks interact with each other, money is being created. It's kind of intriguing. It's an interesting point. And certainly that's when students start to listen. Money creation, okay, by the banks, but only in aggregate. It's through some kind of diffuse process, which is kind of hard to understand. There's the money multiplier formula and so on. But that's only the second theory of banking. And there is a third theory, and that one is the oldest. That one was dominant until the fractional reserve theory took over in the 1920s. So the sort of 30 years before the 1920s. And this one is called the credit creation theory. Now, this one is the most shocking. This one says, wrong, banks are not financial intermediaries. They do not gather deposits and lend them out. As the fractional reserve theory says, because for fractional reserve, ultimately you need excess reserves at the central bank. As now we observe, there's excess reserves, and that's the money you can lend. That's what the fractional reserve theory says. So what's happening now is a typical fractional reserve theory argument. Oh, the banks have excess reserves at the central bank. They should really be lending this to companies, then the economy is helped. And the fractional reserve theory says that, yes, when you have excess reserves, you can lend it. But the credit creation theory, the third theory, the oldest theory, says that's wrong. Both of the other theories are wrong. Banks are not financial intermediaries. They're not financial intermediaries on an aggregate basis and not on an individual basis. Banks are different. Banks are creators of money, but not just in aggregate, as the fractional reserve theory admits. Actually, this happens individually. Each individual bank, when it gives out a loan, this has nothing to do with deposits, or very little, only indirectly to do with deposits. It's not lending out deposits. It is creating new money, which is added to the money supply, and that's the money that is being lent out. It's newly created money. So these three theories, and they've existed at least for the last century. You can find people, arguing over this, and different proponents. There's famous people supporting each of these three theories. There's actually some famous economists who support sequentially all three, and John Maynard Keynes is an example of this. He, when he was young, supported the credit creation theory. He sort of went chronologically, and then he was a key proponent of the fractional reserve theory, and then he became, in his older days, he became a key proponent of the financial intermediation theory. So he became wronger and wronger in his analysis. But yeah, so we have three theories, and I thought, well, hang on, what's the scientific thing to do? Why do we even have to argue? And of course, I already had a view based on my empirical observation, but I also thought, look, I shouldn't need to argue with other economists about this. We just need an empirical test. We need an empirical study of the three theories of banking. And again, it was amazing that in the 5,000-year history of banking, because banking is as old as Babylonia, where there were banks in the modern sense, cashless transactions, loans, collateralized, uncollateralized, international FX, it was all there. But in this 5,000-year history of banking, of course, the bankers always wanted to keep the nuts and bolts and the mechanics of banking somewhat hidden. And as a result, we've never had such an empirical test bringing it out into the open. How do banks actually work? And so I conducted the first such empirical test. In fact, there's two papers on this. If you Google, can banks individually create money out of nothing? You will immediately get it. It's one of the most downloaded papers of all Elsevier scientific journal articles. And the other one is called Lost Century in Economics. And then there's a subtitle, but you also quickly get it. These are the two empirical tests. And the conclusion is banks are not financial intermediaries. They do not lend out deposits. I did this by actually going to the bank. And well, I had to look for a bank that would collaborate with me in this. And I told them, look, I want to take out a real loan, but I want to look inside your system, look into your accounting. As I take out a loan, we are empirically observing exactly what you're doing, because the three theories of banking are different in one respect. That's the biggest difference, and that's where you can see and test which one is right. It is the source of money when a bank lends out, when the banks gives credit. Where does the money come from? And that will tell you which theory is correct, because the financial intermediation theory says, oh, we're using deposits. The fractional reserve theory says, oh, we're using excess reserves at the central bank, which is what they're saying now with this, argument, we need negative rates because that will then drive the money from the central bank to lending. Or is it the credit creation theory, which has big implications for everything and for policy, and would actually also explain a lot of the puzzles? So I did the test, and the conclusion is, as I borrowed this money for real, 200,000 euros, they were a little bit nervous because I insisted, no, I actually have to withdraw this money. Otherwise it's not real.
Yeah.
And that was the point they were slightly concerned about. Maybe this is all just a big hoax by a fraudster trying to run away with 200,000 euros. I didn't. I repaid it fairly quickly, but only after we had all the documentation of the accounting and administrative operational steps in this. Conclusion is, as I got the money, they did not draw down any deposits. In fact, total deposits increased initially by my loan amount. Secondly, they did not use their reserves. Sorry?
By the same amount?
Well, if you can fine-tune it and separate it in that moment, because banks, are live organisms. There's so many transactions taking place. If you could, in theory, hold everything constant, it would be by the same amount. And I show this in the second experiment, which is more controlled. But also, it's not excess reserves. The reserves were not touched at all. They didn't even bother to ask, do we have enough reserves? So that also was rejected. And where did the money come from? It was newly invented out of nothing. The explanation, for those who have never heard this or are not aware of this, the easiest explanation is if you look at it from a legal perspective. The law of banking, the legal status of what a bank does, that gives it away. And the best place to start with that is the mother country of banking, because modern banking started in England, in its modern and formalized version, where also the legal aspects were clarified in the 17th century, City of London. And the legal status is very clear. Now, economists, just to remind ourselves, what do economists say about banks? They say, and this is above the three theories of banking. In general, what is a bank to an economist? It is a deposit-taking institution. They take deposits, okay, that lends money, which is quite reasonable description. That's how economists describe it. But when you study the law, it becomes very clear that this is not true. And at law, banks do not take deposits and banks do not lend money. Why is that? So the first thing that becomes clear is the status of bank deposits at law. When we use the word deposit, I've got deposits at the bank and your money at the bank. We're talking as if that money belongs to us. Why? Well, we've deposited it there, we've given it to the bankers, and it's like held in custody by the bank. In fact, when you invest in stocks and shares, you open an account with a stockbroker, and the money is held in custody. That's the sort of principle we have in mind when we talk about a bank deposit. So we are in control, it's our money, and it's held by the bank as a bailment at law or in custody. But the law is very clear, that's not what a bank deposit is. In fact, surprisingly, there is no such thing as a bank deposit at all. It has no legal status. But when you do what we call bank deposit, this at law is simply a loan we've given to the bank. So deposits are loans we've given to banks. That's what a deposit is. Now then, what is a loan that the bank gives? Well, at law, the law says the bank does not lend money. At law, the bank is in the business of purchasing securities. It's purchasing securities, namely, when you go to the bank, you want to borrow money, or when I did this for this experiment, it is the loan contract that you've signed in which you promise to repay this money. It's your promise. It's a promissory note, or an IOU, as they say in the US. Which is a debt contract, and it's a security. You've issued a security, and the bank is in the business of purchasing that. That's what they're doing. So they're not lending you money, they're purchasing it. And now that's the moment where you probably say, okay, that's too much detail, just give me the money. You know? Any borrower will say, okay, that's lots of technicalities. I just need the loan. I need the money. Aren't you going to give me the money? And the banker will say, well, yes and no. Well, the banker will probably say yes. Yes, you will find it. If the banker is careful and wants to say it correctly, they would say, you'll find your funds in your account with us. Which on the bank balance sheet, the purchase of the loan contract is on the asset side. They've purchased your IOU, your debt instrument, and they've increased the assets now by the same amount. Say it's 200,000 euro loan. That's the loan contract they've purchased, so the balance sheet rises, lengthens by 200,000 euro. And they say to you, you'll find the money in your account. Now, what is the account? Where are these deposits, in inverted commas, held? There's a liability. The liability is for the bank. It is our claims on banks. And the bank says, well, obviously, you're borrowing money from us, you have to open an account with us. And that's where you'll find the money. But actually, it is simply deposit accounts is money, as I said earlier, that the bank owes to us. We've lent it to the bank.
Yeah.
So they're now crediting the borrower by debiting themselves and noting this liability, because essentially bank deposits is just a record of banks' liabilities to us. And because the loan contract says also they have to give you money, they have a liability. And it's that liability that people are using as money. In other words, the accounts payable liability that arises from the loan contract is now recorded on the liability side of the bank balance sheet as, and this is the slight incorrect, sleight of hand, where they're slightly, it's a slight trick. They're renaming this type of liability, accounts payable liability, that's really what it is, as a liability of another type known as customer deposit. Because that's really misleading, because no customer has deposited this money. Certainly the borrower hasn't. That's why they went to the bank in the first place, and no one else has also deposited it. They just write the figure. That's how the money supply is created. As the bank pretends the borrower has deposited the money, and other people can't tell the difference. Is this really deposited, or is this invented by the banks? And that's the money supply. And this is how 97% of our money supply is created. And so this is what the law says. And this is also obviously what the credit creation theory of banking had been saying. In fact, one of the first voices on this in the 19th century who described this quite correctly was, surprise, surprise, a lawyer who knew about the legal status, which is much, much clearer. So the money that we have at the bank in bank deposits is not our money. It's the wrong terminology. We don't have money at the bank. The bank owes us money. We have a claim, and that's it. We've lent it to them. And at law, when you lend something, the borrower has full control, has possession. They own the money. It's their money. We just have a claim, a chosen action, the lawyers say, that we need to enforce. But that's a process. It's not our money. It's the bank's money. And so that's how the money supply is created, by the banks inventing these fictitious deposits. Of course, there's many implications to this for many things. Because this decision of who to lend new money, because it's new money creation, is newly added to the money supply, and that has an impact. I mean, anyone can see this. If you suddenly print money and pump it into an economy, it will do something. Depending on where you put it, it will have an impact. If it is existing money, not newly created money, but existing money, you're simply shifting it from A to B, a shift factor, then yes, you have a gross impact here where you're putting it, but you have a gross negative of equal size somewhere else. You're just transferring. There's more here, but there's less here now. Therefore, the net effect will be very small or zero. Whereas And that's true for other transactions when no banks are involved. But when banks lend money, the key thing is this is new money creation. And suddenly you immediately see why we have asset bubbles, property bubbles, real estate prices going up a lot for several years. What's happening here? Well, it's because it's funded. This is asset purchases funded by banks. And when they lend for asset purchases, it's new money creation. It's you're printing money, you're pumping into the property market, you get a property boom. And so that's why I warned in 2003, I warned in my book, New Paradigm in Macroeconomics, that the ECB, which was brand new, it only started, and I give the reasons, you can look it up, but the conclusion was I expect the ECB now to create massive asset inflation property bubbles through excess bank credit creation, which result in bank crises and bank collapses, which will result in big recessions and large-scale unemployment in the Eurozone. And this is, of course, exactly what they did in Ireland, in Portugal, Spain, Greece, and a number of other countries, where the banks created too much money for asset purchases. That's always unsustainable and always leads to problems. What you need to do instead is, that's the good bank behavior and the good bank credit, where banks help the economy and there's no crises. If you can ensure, and central bankers, regulators could ensure this, that banks mainly or entirely lend for investing, business investment in productive purposes, then you get more goods and services through this productive investment and higher value added, and you get income streams to service and repay these loans. And that's sustainable. You get high economic growth and no crises. That's, of course, what Japan did, what China did, Korea, Taiwan. You can have double-digit economic growth. Even European countries could have that. Very high economic growth, no inflation. You just need to make sure bank credit is used for productive purposes. But if banks create credit for asset purchases, in the short term, it looks great. And a lot of people can earn a lot of money in the short run. But it's never sustainable because it's a Ponzi scheme. It's like a pyramid scheme.
Yeah.
And at some stage, as soon as it only works, it can work for many years, but as soon as new credit creation for asset purchases by banks, as that slows, if the music stops, then the whole thing collapses. The house of cards collapses. You have non-performing loans. The banks then reduce lending further. Then that means there's less money. Asset prices come down. Companies go bankrupt that borrowed, they're overexposed. Banks have more non-performing loans. Ultimately, banks go bust. Credit shrinks further. The whole economy is affected. Unemployment rises. We've had this so many times in the last 250 years. It's nothing new. And it's whenever you create credit for asset purchases. So I showed this actually in 1992 in my quantity theory of disaggregated credit. I showed the link between bank credit creation and the economy and asset prices and also capital flows, actually. So it's been quite a useful little theory, which has stood the test of time very well. And it shows that we can prevent asset bubbles. We can prevent banking crises. We don't need complex bank regulation. This just puts a burden on small banks if we have such complex bank regulation. That's why since the ECB started business, almost 5,000 banks have disappeared. These are the small local banks, cooperative banks, community banks. They've disappeared in the Eurozone because they've stepped up always as solution, have more regulation. But it's the wrong type of regulation. That doesn't help. And the wrong interest rate policy. So you see, this fractional reserve theory says if the banks have these excess reserves at the central bank, then we need to drive the money out into the economy. They need to lend this because that's what banks do. They lend this. But I've shown in my work this theory is wrong, and specifically, it's doubly wrong because the fact is that the reserves that banks
the money never leaves the central bank.
Yeah. Exactly. The bank's reserves at the central bank cannot leave the central bank. It's a closed loop. It's entirely under the central bank's control. And therefore, but you see how disingenuous this whole story is, because the public is being told the wrong story. It's easy to be misled when you see all these excess big reserves the banks have. Yes, they should lend the money to the economy. That's sensible. but they can't.
Mm-hmm.
They don't need to. They can create their own credit.
Yeah.
Now, this is where the negative rate policy is so dangerous, because not only will it not achieve its goal,
Mm-hmm.
you cannot drive these huge excess reserves. They come from the central bank's purchase of assets and bonds and
Yeah.
from the banks. So now they have, they pay the banks in reserve. So that huge reserve piles the banks have with the central bank in the Eurozone is massive.
Mm-hmm.
But you cannot drive this money into bank lending. It's a
Mm-hmm.
physical impossibility. So you'll never achieve that goal. That's
Yeah.
already a given. It's a
Mm-hmm.
given by
Mm-hmm.
definition. That's the system.
Mm-hmm.
It's an unalterable reality. You need to change the system if you want to change
Yeah.
that. So that's not going to happen. But on top of that, there will be an effect, but not a positive effect. There will be a negative effect. Why? Now the banks, like in the Eurozone, let's take that example, they've essentially been forced to hold these huge excess reserves by the central bank through their so-called QE. I
Mm-hmm.
mean, I proposed quantitative easing as the first person in 1995 in Tokyo. It's published in the Nikkei newspaper, financial newspaper, 2nd of September 1995. We need a monetary policy, which I called quantitative easing,
Mm-hmm.
to get out of this post-banking crisis recession.
Mm-hmm.
And of course, it had to do with, I've told you already, all the solutions. How do you get out? You
Mm-hmm.
need the central bank to help the banks. But how do you help them? Not through negative rates. That hurts the banks, as I'll tell you in a minute.
Mm-hmm.
You help the banks by getting rid of their non-performing assets from the prior asset bubble that central bank policy had created. So
Yeah.
the central bank can just purchase the non-performing assets at face value and they're gone. And the
Mm-hmm.
banks are healthy. And this doesn't cost tax money. There's
Mm-hmm.
no fiscal tightening and austerity needed for this at all.
Mm-hmm.
And then the central bank should try to get the banks to create credit. And that can be easily done. There's a whole number of ways in which bank credit creation can be encouraged, but it doesn't involve lowering rates or negative rates. Quite the opposite. You need a positive yield curve. You need to push up long rates, because then lending to companies becomes profitable.
Yeah.
But what they've done is the opposite. So back to these negative rates. So the way they've done QE is they just purchased assets from the banks that were performing, namely the sovereign bonds and things like that. And the banks were then given these huge amounts of cash, which is the reserves at the central bank. And now the central bank says, now we're going to impose negative rates. You're holding these, hundreds of billions of euros in excess reserves. We're going to punish you now. We're going to apply negative rates. That means you have to pay us now for this.
Mm-hmm.
Well, okay, so banks are being taxed. That means they will get weaker. They have to draw resources from elsewhere. What we found in the Swiss banks is where this was done first. That's why they charged their customers more. The borrowing customers, the small firms that borrowed money, had to pay higher rates, because the banks needed to get the money to give to the central bank, the negative rates from somewhere. In the Eurozone, there's so many banks, and say in Germany, this has largest number of banks. It's highly competitive, so it's difficult for them to actually raise rates. So what will it do? It will force these banks out of business. So banks will die, they'll be forced to merge, and they will disappear, and this will accelerate this trend of a declining number of banks. But when you reduce the number of banks, economic growth is going to go down.
Mm-hmm.
The more banks you have, the better, because that's decentralized decision making about this decision. Who is going to get how much money for what transaction? Is it going to be productive? Can it be serviced and repaid? That's a micro decision. You need to kick the tires. You need to be on the ground, check out the small firms.
Mm-hmm.
And you need hundreds, thousands of banks, and they have each hundreds and thousands of branches with thousands of loan officers. That's a good system. If you have one central decision maker, like in the Soviet Union, who decides how much money is going to be created, well, you can be sure this is not going to be productively put into the economy. It's going to be a disaster. So that's the trouble. And so therefore, negative rates will not achieve their goal. They will achieve the opposite of killing the banking system, killing the banks from the small banks up. The big banks will survive the longest,
Mm-hmm.
because they actually make money on this so-called QE, these asset transactions, because it creates an asset bubble in particular financial instruments. So they're fine, they play this game. But the small banks, particularly the community banks, they have a mandate that essentially they can't invest so heavily in the bond market. They lend locally, but that becomes unviable.
Mm-hmm.
And therefore they're driven out of business.
Mm-hmm.
And so that's the trouble. And then this whole negative rate policy is actually highly counterproductive. And there's no empirical evidence that it's positive for the economy, yet it's being still pursued by policymakers. They need to look at the empirical evidence and change these policies.
Before we go further into the boom and bust cycles and ECB, just one question. When back in 2008, I interviewed Hugh Hendry at Eclectica in London. He pointed the finger at the 99 removal of Glass-Steagall Act and called for reinstating it. It seems nothing has been done in this regard whatsoever, of course.
I would entirely agree with him that the Glass-Steagall Act served a purpose. Remember, it was introduced in 1933.
Yeah.
As they saw what went wrong, it was first the banking and financial crisis and then the beginning of the Great Depression. And they said, oh, we need to separate the speculative banking from the more utility banking, deposit banking for the real economy. That, in a way, you could argue it's not precise, but it was a simple way that in those days, the regulators with far less data available than we have tried to achieve what I've told you, that we need to make sure bank credit creation goes mainly into the real economy for productive business investment. And the whole speculative thing shouldn't be funded from bank credit.
Mm-hmm.
And that really, in a way, is what this Glass-Steagall Act tried to achieve. Now, because it wasn't fully articulated, and therefore was also not entirely congruent in terms of the wording, it wasn't perfect, but it went a long way because it did separate. For example, look at Morgan's, JP Morgan.
Mm-hmm.
It used to be JP Morgan Bank. And because they were then told by the lawmakers, no, all your financial speculation bit, you have to break out.
Mm-hmm.
They had to create a new company. Morgan Stanley, which was a securities company, was broken out. And that's an example. And the idea was, okay, and JP Morgan does more the real economy lending, more traditional banking, and the other guys do their speculation, but they don't have a banking license. They're a securities company. They can't create money. And that is very sensible. And that's very close to, in spirit, to what I've been saying, and also what my quantity theory of disaggregated credit says. And therefore, and when this was abolished under President Clinton in 1999, suddenly it makes it much easier because now banks creating money could plow in much more actively into the financial speculation. And of course, then bank credit was much more diverted for asset markets. So I entirely agree with this analysis. Well, when I first published or when there was a first widely read publication about my quantity theory of disaggregated credit, that was in The Economist. In June 1993, it's a weekly paper. I can't remember which date exactly, but it's a June 93 issue of The Economist. I'm sure one can find it on the internet. Some of my references quoted. And they wrote in the Economics Focus entirely on my paper and my approach, of course, with Japanese data. It was the 90s. But very positive and clearly pointing out that that's a new approach, which explains a lot. And bank credit creation and should be considered more by economists, this approach, and should be used by policymakers. So after this came out, because Economist is widely read, particularly by central bankers and the like, I got letters from JP Morgan, Rothschild, also the big banks, private banks, but also from central banks. Quite a few central banks wrote to me, and particularly the Fed was very active. And because remember, this is pre-internet. This came out in 1993. And they had to write to me to get the actual paper. I had published it, presented it at several conferences, but it wasn't like you could go to a website and get download the paper.
Yeah.
So at least the advantage was I could see who was interested in this, and the Federal Reserve was very interested. The board of governors of the Federal Reserve System wrote to me, senior economist Dale Henderson, and asked for the paper. And he said, and there was a fax, a phone call, everything. This is really urgent because the senior board member of the board of governors wants to read the paper. So it was veiled, senior board member. Well, okay, this could be the senior board member, Alan Greenspan, or not. You never know.
Yeah.
But when so I sent them the paper, didn't hear back. This is 93. And then when 2 years later, in 95, I was then chief economist at Jardine Fleming Securities in Tokyo,
Uh-huh.
but on a roadshow to the largest U.S. institutional investors, all the big funds in various places in the U.S. And as I was going through Washington, I set up a meeting at the Fed as well. And I then asked, oh, by the way, 2 years ago when we had this exchange of well, not emails, faxes and phone calls, who was that senior board member who wanted to read my paper? Oh, that was Alan, of course. Oh, okay, that's good to know. Because then another 2 years later, so now we're in 1997, and the World Bank and IMF annual meetings every other year, they take place in some international location, taking turns with Washington. And so this happened to be in Hong Kong, because my company, Jardine Fleming, headquartered in Hong Kong, of course, then was giving a big dinner event for all these globally assembled bankers and central bankers. It's a big annual bash for all the bankers. And because my company was hosting this dinner, I got myself also invited, and I was looking out, and there he was, Alan Greenspan. Okay, of course, always crowds around him. Everyone wants to have a piece of the cake and talk to him, because these were the days he was already the maestro, and of course in this bankers event, he was probably the number one figure. But there was a moment, for some reason, there was a lull, and he was standing there on his own. So, okay, that's, just going to walk up. I've got a chat up line. I know he read one of my papers, but obviously that's 4 years ago. So, of course, he, wouldn't remember that. So I'll remind him of that, and then we can talk about my paper and things. So I walked up and, according to plan, said, may I introduce myself? My name is Richard Werner. I believe you've read some of my research. Now, I expected him to say, oh, really? Like, what's that? But he said, Richard Werner, credit creation. Yeah, I remember the paper on Japan. I read it twice. And The Economist, and then the actual paper. And I was somewhat speechless. Well, I mean, he said all the things I wanted to say, so and he remembered every detail, everything. It was slightly scary, actually. So then I said, and also remember, he said, as after my name, he said credit creation, magic words. So then I said, oh, well, would you venture to comment on my paper? Fair enough, especially since he remembered so extremely well. What does he say? He says, can't remember. Turns around and walks away. Doesn't even say goodbye. What? So what can you conclude from this encounter? Well, I concluded, well, he knows my name. He knows credit creation. He remembers every detail. So it's clearly, there must be a reason why he remembers so well. But he claims he doesn't remember and walks away, like, in other words, he didn't want to talk to me. Possibly because he didn't want to give me even more information than he had by even the few things he said. So next thing is, back in Tokyo, I checked out. We had this Reuters 3000 system where you could check all sorts of publications, including all the Federal Reserve publications, all the speeches of Alan Greenspan, and So I just put in keyword credit creation. I mean, that was him saying it. I hadn't said it. I had said nothing. I just said, Richard Werner, I believe you read some of my research. He came out with it. So let's see. He clearly seemed to know this concept pretty well. You know what I found? Of all his speeches and publications, which were a lot, how many times has he used the words credit creation? During his entire time at the Fed. The word count, the hit count was 0. Never. Exactly never. Oh, that's interesting. That's very interesting. Now then I went beyond. Okay, we need to go before he joined the Fed. Oh, bingo. There he did publish it. In fact, it's his I think 1967 paper in this book by was it what she called Ayn Rand. Ayn Rand, is the editor, and there's various chapters, and he has a chapter which is about gold, interesting, and about central banking and about credit creation. And if you put these words together, you know what the storyline can only be. When you have central banks, they create too much credit, money creation, which creates boom bust cycles. He criticized the Fed for the 20th bubble and the 1930s depression. And obviously, gold is a hedge. That's safer money. That was essentially, in a nutshell, what he was saying. But he mentions credit creation quite a bit in there, and how this process moves the economy, creates the boom bust cycles that we've been talking about.
Already in 67?
Yes, yeah. No, I think it's 1967.
Wow.
And but you see, so he knew a bit too much. Then he was offered a job at the Fed, and obviously he decided never, ever to mention the words credit creation. Why? Because they were linked to the credit creation theory of banking, which has been swept under the carpet for decades as the fractional reserve theory, and also the present day financial intermediation theory of banking has been propagated.
Yeah.
And all the textbooks are full of it, and they were not supposed to mention the old credit creation theory of banking. So the money creation powers were well hidden.
Gaslighting.
Yeah. Indeed. So yes.
Why would any central bank aim to creating conditions for boom bust cycle?
Yes, that's a good question. I mean, again, starting from an empirical perspective with the actual experience of the Bank of Japan, what I found there, and this is described, in every detail in this book here, Princes of the Yen.
Yeah, I need to buy it. I saw a movie, fantastic.
Okay. Well, the movie couldn't cover really all that much, but essentially you have to condense it to more or less one storyline, but you get quite a few storylines in here. This, by the way, you can only get this from www.quantumpublishers.com.
Okay.
That's the website of the publisher. Buy there directly. Amazon will charge you much more, and it's much harder to get. Amazon US, I think, but go to quantumpublishers.com directly, and it's much cheaper. Anyway, so in this book, it's sort of my empirical journey analyzing what happened in Japan. And initially, I wasn't aware of any of this, and I wouldn't have believed it if I hadn't seen the facts. So I arrived in Japan first in '89 at the peak of the bubble. I was at Deutsche Bank. Actually, quite interesting experience. That's for another time. And then 1990, 91, I was there as a researcher at the Nomura Research Institute, and also University of Tokyo, and then Japan Development Bank, doing my empirical research on actually banking, the property market, and capital flows. These were the sort of topics I was looking at. And essentially, it was clear that big things were happening. There was a lot of asset price rises, property prices had risen tremendously, and There was also the capital flow story, massive capital outflows out of Japan into the world. And then the whole thing was on the verge of reversing on all fronts. And I was looking for a link. And now, and then of course, what happened later was that capital flows collapsed, asset prices collapsed, banks collapsed, the whole economy collapsed. And but it took a while to get there. I mean, 91, when we had 7-8% interest rates, the Bank of Japan lowered rates for the first time, and we're coming full circle now to the beginning of our conversation. So central bank was saying, you know, we've got lower interest rates in order to stimulate the economy. The stock market had fallen. That was, you know, the first signal, but you know, the economy is still growing at 7%. So not a big problem, people thought. And the central bank is lowering rates, so buy Japanese stocks that become cheap, and you know, now they're lowering rates, so that's great. I put out my first paper based on this analysis, concluding that actually Japanese banks are going to go bankrupt and Japan is going to move into the biggest recession since the Great Depression. And for years, people thought this guy knows nothing about Japan. It's impossible. It's going to be the Japanese century, they told us. Japan is going to take over the world. The top 20 banks in the world were Japanese, and this guy is saying they're going to go bankrupt. He clearly doesn't know what he's talking about. But then, of course, this happened, and more people realized what's going on. I got my job offer at Jardine Fleming as chief economist, and I met a lot of central bankers, also privately, and bankers and so on. And in these conversations, it became quite clear that the central bank was not really interested in ending the recession. And initially, it's puzzling, and I didn't believe it. I thought, okay, this surely they want to end the recession. I always gave them advice, and you know, why did you do this and that? And sometimes there were excuses, but I kept pushing this over the years, talking to them, and several then came out and said, look, Richard, you know, we know you're saying all these things, but the Bank of Japan does not want to create a recovery. Why? Well, why not? Because by having a recession, we're putting pressure on the system to change the economic structure. We want a structural change. And then, so once I heard this, initially I didn't believe it, but then looked for evidence. And sure enough, when you look for it, you will find the evidence. It's all spelled out in Princes of the Yen. Actually, the key decision makers, Mr. Mieno and Mr. Fukui, governor, deputy governor of the Bank of Japan in the late 80s and in the 90s, they said it. They said, actually, we're trying to engineer a structural transformation of the Japanese economy. The typical Japanese style export-oriented economic system must be ended. And we need to deregulate, liberalize, and privatize, and import more.
Like, in fact, it was unsuccessful until then.
Well, exactly. It was highly successful. So really what they were saying is exactly the same what the US was demanding in the so-called Structural Impediments Initiative and all these negotiations with Japan. It was the wish list by the Americans, which is being implemented by the Bank of Japan. And think about it, how do you persuade a highly successful economy to change its system? The Americans tried to argue, well, we try to help you, what, to become more successful? That was actually the argument. Oh, you're inefficient. There's some inefficiencies. There's too much government intervention, which makes things inefficient. Do what we say, deregulate, liberalize, and privatize. You'll be even more successful. Really? Did they really want that? No, of course, the true story was Japan was too successful and had to be weakened. Its economy had to be slowed. And the best way to do that was to deregulate, liberalize, and privatize and destroy all the foundations of success, including the banking system. And now these are huge changes. These are political changes because you also need to change laws for this. How can you engineer all that? And interestingly, Mr. Mieno, when he was deputy governor of the Bank of Japan, already said that monetary policy was going to be used for this. This is written up in the Maekawa report. That was his boss. He was also previously governor of the central bank, Maekawa, but it was written by Mr. Mieno, who was the next governor in line, one of the princes. You know, they were always in charge 5 years as deputy and then 5 years as governor. So 10 years, one guy in charge. They were selected 30 years beforehand. So it was very well chosen, tapped on the shoulder, selected, and therefore known as the prince. Oh, he's going to be governor in 30 years. That's how it worked. That's why princes of the yen. It's not my expression. That's how they were known. They used the English word prince. He's the prince. Why? He's going to be governor in 25 years. Anyway, so they published these reports. This is published. So the Maekawa report said that we're going to have deregulation, liberalization, privatization. We shift away from exports to domestic demand expansion. It's all, quoted in my book. You can get it all nicely together there. And how are we going to achieve this? This is a revolution of the system. And they only say these mysterious words, well, we have to use monetary policy. And then Mr. Mieno, under his own name, said, for the structural transformation that we need, we have to use monetary policy flexibly. Very interesting. Now tell me, how can you use traditional monetary policy, lowering, raising rates, to achieve that? We know empirically you can't even move GDP with that because rates follow GDP, right? So, but how can you get a structural transformation of the economy, smash the old successful system and put in a system that's a shadow of its former self, that's not going to get the Americans nervous because of its great export prowess? How do you do that with monetary policy? Well, there is a way. There is a way. And the way is you blow up the system. And you do this by creating a bubble. And that works because nobody's going to stop you, because everyone is going to make money. All the property developers, the banks, they're all making money. And then the fringes, people involved with that, and then other speculators chip in. The tax man, tax office, the finance minister is happy because tax revenues go up. Everyone seems to be doing well. Japan seems to be booming. And they don't realize that is an illusion. This is blowing up the system. And then once they achieve that and they create it, then you just need to trigger it. You stop the credit creation for asset purchases. You get your recession banking crisis. And then the central bank can fine tune that crisis. It can be 20 years, 10 years, 1 year. You can end it after half a year. There doesn't need to be a recession. You can end it before it starts if you want to. So that's this type of recession they like, because they can fine tune it and extend it as much as they want. And it turns out the Japanese people are so resilient and resistant to change. The Bank of Japan needed over 20 years of recession to break their conviction and their resistance. And so we've had now only in 2013-14 the beginnings of a reflation. I mean, it's amazing. It's like 25 years of recession, but entirely unnecessary. The huge government debt created, entirely unnecessary. This could have been spent on environmentally friendly, environment enhancing, sustainable economic growth that makes everyone much better off, supporting, for example, families to have more children. They have a demographic problem. Well, the central bank could have created money, QE for babies. If you pay out 200,000 euros per baby, you watch fertility go through the roof. Done some studies on that, actually. So all these good things could have been done, but weren't done because they were pursuing doggedly this policy of smashing the old system and having the structural transformation of the economy. Now, that's one case study in answer to your question.
Excuse me, did the BOJ have any such political mandate to be flexible, or not really?
Of course not. Of course not. In fact, in the documentary Princes of the Yen, I asked that question to Monsieur Trichet in Davos at the World Economic Forum. There's a short section because that was video recorded. And I asked him, because he had just given a speech to the elite of the world, but lots of Europeans there, of course, in Davos. How Europe needs structural reform, deregulation, liberalization, privatization, and how this must happen. And he's a central banker, senior person at the ECB. And so I just asked the question, where in the mandate of the ECB does it say that, the central bank should be concerned with the economic structure and engineering structural transformation? You should see his answer. It is somewhat embarrassing.
I think he dodged it, if I remember correctly.
Well, he dodged it, but in a way that I think was very telling.
Yeah.
Dodged it in a very telling way.
If we go further to the ECB, you have long ago dismissed comparison of ECB to the Bundesbank and instead compared it to the notorious Reichsbank. What makes you say that, and what key differences between the two would you point out?
Well, the list of parallels and similarities is so long.
The
I would
major
have to
ones.
think. I should think which ones are the key ones. So again, there's actually a whole chapter in Princes of the Yen. At the end, it's the chapter, the ECB as the revived Reichsbank. That gives you more details, but I'll give you a few points. In fact, remember, this book was published in 2003. And then various things happened. I had to take out the Greenspan chapter, so that one wasn't published in English. It was published in the original Japanese version in 2001, but it's only in this new edition. We have the long lost Greenspan chapter back now. Because now it's okay, it seems, to tell the story. But on the ECB, so this is published in 2003 with the ECB chapter, and I predicted that the ECB was going to do these things, create what happened in Ireland, Portugal, Spain, and Greece, these banking crises and busts and large-scale dislocation. In fact, essentially they were following the Bank of Japan script, where a central bank blows up the system. I had since, after I published this, then also been, talking to various senior people, and including senior ECB people, and they privately told me they were very concerned about the excessive powers of the ECB. And this was already after 2009, I think around 2011 or 12, how the ECB was abusing this power to extort political changes from member countries. Obviously, we've seen this. We've seen what happened in Cyprus. We saw what happened in Greece. There they shut down the banking system. That was an ECB decision. But that was the threat they had also made in Spain. And that's why Spain caved in and signed, okay, we will give away sovereignty. Yes, we will give away fiscal powers to Brussels. This is how this whole, the big political changes happened, because already European countries in the Eurozone have given away monetary policy to the ECB and have given away their own currencies in order to adopt a foreign currency. The euro is a foreign currency for each country, for everyone, also for Germany. It's a foreign currency. That has implications. It has also stability implications. When you're under pressure and need short-term funding, that means these countries are essentially, they are susceptible to blackmail, particularly when you have debts in Target 2 and so on, and external debt, national debt. You don't have your own central bank. Of course, you can be put under pressure very easily. You can be squeezed. And so this has become increasingly recognized, these excessive powers. Now, I wrote in 2003 this analysis by simply comparing the legal structure of the ECB and the Bundesbank and the Reichsbank. So again, the law tells you a lot, because essentially we're dealing with human institutions. There are various informal rules, but the formal ones ultimately are laws. They're the formal ones, and that you can enforce them in court. And by looking at the legal status of the central bank, it became very clear to me already very early on. I mean, ECB had just started 3 years earlier or so. Which ones looked similar? Because everyone is saying, oh, ECB is going to be like the Bundesbank. That's why it's in Frankfurt. It's going to be, the big lesson from the Bundesbank has been learned. We know Bundesbank was a good central bank, which is true, by the way. I think it's one of the few central banks that have been good central banks.
Yeah.
So ECB is going to be like that. That was the official story. And I warned that, to me, it looks anything but like the Bundesbank. And what I showed and show in this chapter is that instead, the ECB was designed to be like the Reichsbank, which was one of the worst, if not the worst, central bank in history. And that's a big contrast there. So I'll just give you a few points. The standard argument is
Independence.
yes, independence. We
Government.
need
Yeah.
the standard argument is the
also.
Bundesbank was successful because, as you say, it's been independent. Now, there's two points here. First of all, what is success? The Bundesbank was successful, but it's not just because inflation was low. Inflation was even lower, say, in Japan, and there the central bank was not independent. So there is actually not a good link there. In fact, there's empirical studies showing that the independence of the central bank and inflation, there's not much of a link. That's been debunked. There's some false stories out there, but they've been debunked, like by James Forder of Oxford. You see that. But there's another question. So success is low inflation the main point of success? And I pointed out already that from my analysis of Japan, no, there's another dimension, and the measure of success of the central bank is whether we have boom bust cycles. And ultimately, that can be much more painful and costly if you have big boom bust cycles, big unemployment, big dislocation, Great Depression. There was no inflation in the Great Depression, was there?
Yeah.
There was deflation.
Yeah.
The inflation thing is actually not the right measure. And so I expanded this to also include boom bust cycles, banking crises, big recessions. And if we don't have these and we don't have inflation, then that is a good central bank, good monetary policy. Now, the other dimension you need to look at is independence. What actually is independence? Independent from who? Now, people thought that the Bundesbank was successful because it was made independent from the government. And as a result, it had low inflation. And if you include my wider definition, it also avoided the big boom bust cycles. So no doubt it was successful on all counts. But people thought it's because it was made more independent. I studied then the Reichsbank and concluded that actually the opposite is true. The opposite is true. Those who wrote the Bundesbank laws in the post-war era, they did study the Reichsbank, and they saw what went wrong. And they concluded that in order to make the central bank successful, we need to reduce the independence of the central bank. We need to make it less independent. And that's what they did. Because as it turns out, the Bundesbank is far less independent than the Reichsbank was. So now briefly, analysis of the Reichsbank. The Reichsbank was not just independent from the government, like the Bundesbank was, but it was also independent from any democratic assembly. It was independent from parliament. Now that is shocking. That is unusual.
No accountability, yeah.
There was no accountability. There's nothing lawmakers could do. That means it's outside the law, above the law. And on top of that, it was, of course, that's Reichsbank specific. It was also 100% privately owned. So, and as it turns out, there was some influence by, the reparations committee and outside forces. But for Germany, there was nobody in Germany who could do anything about it. Government, parliament, parliamentarian, nobody could influence it. Now that's exactly the status that was copied with the ECB. The Bundesbank was only independent from the government, but it was accountable to Parliament, and Parliament did make laws that the Bundesbank stuck to. The famous Stability and Growth Pact, where the Bundesbank was told, no, it's not enough just to deliver low inflation, you need to also deliver economic performance. And they did. That was a law by Parliament. But the ECB status is such that no democratic assembly, no parliament can do anything about the ECB. And therefore, that is identical to the Reichsbank. And I showed with the Reichsbank that that was the problem. It was above the law. It could do anything it wanted, and it did. As Lord Acton says, an early British European. He was half German. His mother was a Bavarian princess. Um, Lord Acton, a well-known figure in Britain, he said, and he worked closely with various prime ministers, and he saw the power, and he concluded, power corrupts. Absolute power corrupts absolutely. The main dominant problem of the 20th century has been concentration of power in the hands of the few. And the more you do that, the more you'll get. That's the problem with human nature. People cannot handle power, they yield to temptation, and power will be abused.
Mm-hmm.
And the Reichsbank was too powerful. There was no accountability. It was above the law. There was nothing even the police could do, or public prosecutors. If they think they're doing criminal stuff, they couldn't do anything about the Reichsbank. Well, read the statutes of the ECB. It's the same status. The ECB is not even in Germany. It's not in Frankfurt. No. Where is it? It's in ECB country. Literally, because the place where it is extraterritorial. It's like an embassy. It's not part of the country. It's foreign territory.
Mm-hmm.
Because like the status was pioneered by the BIS in Switzerland.
Like City of London.
And City of London is another sovereign territory. So, and no public prosecutor can demand even the minutes or other documents by what they're up to. So we have too much power, and this power sadly has already been abused. Now, I think there's a lot of good people at the ECB, smart people, and also well-meaning people. So it's really a problem of institutional design. And when the 2008 crisis happened, and I'm known as a bank critic, I actually didn't criticize the big banks really, because ultimately the bankers were just doing what the incentive structure we gave them told them to do.
Yeah.
Nobody told them lend wisely and lend for productive purposes. Nobody told them that. The regulators didn't tell them that.
Mm-hmm.
So actually you can't blame them. Now, likewise, once we create this type of structure, legal structure called the ECB, we can't actually blame the humans in there. That's just they're following the system we've created, and there's many well-meaning people in there, but the incentive structure is just not the right incentive structure.
Mm-hmm.
And it happened faster than I thought. I was slightly surprised by how quickly the ECB would precisely copy the Reichsbank policies.
Mm-hmm.
And so already from 2004, only a year later after I published this warning, started to expand bank credit dramatically in Ireland, Portugal, Spain, and Greece, double-digit growth, 20%, 30%, 40% credit growth. Where's it going? Not into GDP, into property, asset purchases, creating property bubbles, which will blow up your banking system. So it's just same old, same old. We didn't need this. It was avoidable.
Mm-hmm. What was actually what were the levers of ECB leading to such unsustainable credit growth?
Well, it's just the incentive structure that was wrongly applied, and essentially it's the whole regulatory framework. It starts with Basel. The whole Basel approach already is wrong because it gives a lower risk weight for property transactions. And then they stepped this up for Basel II, and the ECB itself, because the ECB is actually called ECB system. It consists of the national central banks. And in Ireland and in Spain, the central banks, which are part of the ECB, the component of the ECB, at the same time, they're bank regulators. They already were bank regulators. Often this is forgotten because afterwards the ECB said, oh, we had these problems because ECB wasn't powerful enough. Literally, that's what they argued. I warned in my 2005 book, New Paradigm in Macroeconomics, that once we get the next banking crisis, they will do all the wrong things. Because after each crisis, the regulators get more powers. That's the wrong way. Then we get more crises. We have regulatory moral hazard. If each crisis makes them more powerful, they have an incentive to have another crisis. They get even more powerful. Sadly, that's what they did. So the ECB argument that it didn't have enough powers, it should also be a bank regulator. That's not true. It was already bank regulator in Ireland and Spain through their national central banks.
Yeah.
So you had that wrong regulation, but also the central coordination was wrong, because of course the ECB had excellent data, better than anyone, on bank credit in Ireland, in Portugal, in Spain, and Greece. It already had my analysis of disaggregated credit and what this was going to do. But they let it happen. In fact, they ensured that the incentive structure was right for banks just to keep going like this. They
Mm-hmm.
could have stepped in. Now, the ECB, sometimes the ECB says, well, we didn't have enough tools. Now,
Mm-hmm.
this is really not true. They chose to say that we only use interest rates. That's their choice. Nobody forces them to only use interest rates. We know interest rates is not a good policy tool. Why
With
do
all
they
the
even?
massive regulation being imposed on banks. Come on.
Yeah, exactly. So the ECB could have, it can invent new policy tools if it wants to every day. It
Yeah.
can. The main power, of course, is by a central bank to just call up the chief executive of the banks and say, look, we've noticed you've lent too much to property here.
Yeah. Yeah.
We think a bubble is happening. They have the data. They know this. You know, please slow this down. This will
Mm-hmm.
be enough. They don't even have to do any more than this. Just a phone call. And they would say, okay, yes, sir, because a bank is so dependent on the central bank.
Mm-hmm.
I saw this in Japan. And it's a relationship that can be very productive when it's a relationship of mutual trust. The central bank is more powerful because it's the regulator. It can take away the banking license.
Mm-hmm.
Um, but the bank is the connection to the economy, to ordinary people, to small businesses. So for both parties, it's a good relationship. And ultimately, both parties should maintain this good relationship. But a banker will always do what the central bank says.
Mm-hmm.
But this relationship should not be abused.
Mm-hmm.
So, and the central bank, it does also mean the central bank needs to sometimes say, oh, by the way, we noticed. You wouldn't know because you only do your own bank, but we do all banks, and when we add it up, we noticed bank credit to property purchases is
Mm-hmm.
going through the roof.
Mm-hmm.
So you got to slow this now. That's all they need to do. It will work. They will slow it. Why?
Yeah.
Well, we got a call from the central bank. Sorry, guys, we got to do what they tell us, and they will do it. Well, that's right. The central bank should have this power, and it has this power, but it also has to use this power at the right moment. And the ECB just combined managed to get everything wrong. But I'm not surprised. In fact, I was warning about this because this wrong incentive structure. The ECB was going to benefit from this bust that was going to happen by becoming even more powerful.
So it's a highly unlikely that it's a matter of I don't know, incompetence. It's it's it's
Yeah, essentially, they're
it seems
quite
like a
competent
power
people.
game. It seems
They're
like a power.
competent people, and also to a large extent, well-meaning people,
Mm-hmm.
but it's in the wrong incentive structure. So we need to, I think the general public and uh, members of parliament need to demand accountability from the central bank.
Mm-hmm.
Possibly even just demanding it consistently and loudly will be enough. Maybe we don't need to change laws,
Mm-hmm.
but they need to know that, they have to do this responsibly for the benefit of the community. And it can be done. And then I think it will happen. So we just need to make our voices heard, I think, on this.
You mentioned earlier on the Sovietization of the banking system. Is this actually the same game of power by the ECB to become, I don't know, the only player in town?
Yes, well, that's how I formulated it in another interview. The game to become the only player in town. If we have no change in policy, then that's what you're heading for. So, is this really what everyone wants? We need to be aware of this. And I think if the ECB really reflects on this, and at the moment there's actually an internal reflection program going on. The new president, Madame Lagarde, said, we want to reflect on monetary policy, and I think they should reflect on this. Do they really want to become the only bank left in the Eurozone? And if that's not their intention, well, then please change your policies now, very quickly, and do not continue the negative rate policy. That's just killing banks. Even more banks will disappear. Abandon that, have positive short-term rates, and give a signal to the bond market that you're slowing bond purchases and you're going to stop bond purchases, and suddenly you'll see bond rates going up. You have a positive yield curve, then banks know, yes, it is again profitable to lend. They don't need those reserves. Forget about that. They will create credit.
Yeah.
And the central bank should also say, oh, by the way, we've learned our lesson. Now all the banks, please create credit for business lending, for business investment, especially SMEs. We're going to lower the Basel risk weight, or the risk weight. They don't need Basel. The ECB can just decide this. We're going to lower the risk weight, no matter what Basel says. ECB decides that actually, if you think about it, if you do a proper analysis, the lowest risk lending, apart from lending to the sovereign, is lending to SMEs. Tell me, how many banking crises have there been due to too much bank lending to productive SMEs for business investment?
None.
None, exactly.
Yeah.
So they should say, okay, we'll also change the rules, and you won't have to have so much capital for SME lending. We'll increase capital requirements for property lending and things like that.
So the decentralization goes of the banking system goes with it, right? The creation of
Yes.
not-for-profit local banks.
Oh, yes. Now that you mention it, we should set up not-for-profit community banks. By the
Yeah.
way, not-for-profit doesn't mean they're not profitable. They're actually highly profitable. Banking is profitable, but they're stakeholder banks. So all these profits, they
Get
belong to the
reinvested.
community. They go back one way or another to the community
Yeah.
through professional banking, conservative professional banking. And you see, I think one way the regulators will realize this is actually quite a good idea is when they realize that when you have a decentralized banking system with many small banks, and small banks we know are much better capitalized than big banks, percentage wise, they have always been. This system is more resilient, it's more stable. And when there's a shock, there's a crisis, that's the system that does best. Look at Germany, it did best, in the 2008, 2009 crisis, it really fared well. And again, 2020, I expect Germany will do better than other countries because of this system. Even when you want to put in government money, well, once you have the system of decentralized local banks, that's an efficient way of putting the money into the system. Also, loan guarantees. In the UK, there aren't enough local banks, and therefore there's a big problem to get the money to where it's needed. Small firms, SMEs, entrepreneurs. This can be done. And then regulators will see their job is getting easier because there won't be the scandals, there won't be if you have ethical local stakeholder banks, far fewer scandals, far fewer negative stories in the papers, and the regulators look much better. And also you won't have banking crises, and you won't have big shocks to the system. So
Are
really,
the
it does make everyone's life easier.
are the banks which are part of the ECB able to give their own window guidance to their commercial banks?
That's an interesting question. I believe the answer is, well, in a legal sense, technical sense, yes, but then there's politics. So whether in reality, in a political sense, they will be allowed to by the center, we don't know. Maybe it's slightly doubtful. But again, if there's public support for it, the public, I think, has a lot of influence. If the public speaks more about this and demands, why don't we have credit guidance, window guidance by the central banks to discourage the asset purchase lending and encourage lending to SMEs. And we also changed the Basel rules concerning their capital adequacy. The regulators ultimately will listen. I think that's what's needed. Maybe the problem is simply that, like with scientists, when they're too focused on their research and they don't talk to people in society, they actually end up going on the wrong path of science. It's still science, but it's not sort of disconnected from reality. And I think we've given too much independence to central bankers. They may be well-meaning, but they're too much focused on their, areas without thinking, how does this link back to society? And when they realize, oh, actually, society is now demanding this, oh, we've neglected to engage with society on this and all the feedback concerning wrong policies, we need to change that. I think, one can have a much healthier and better relationship and better regulation of banks and better economic performance, more job creation. I mean, small banks lend to small companies. They're the ones that create jobs. So for any politician, it should be a no-brainer. They should support the creation of new local banks, and they don't cost much. They're quite cheap to set up, and the IT and the technical requirements, they're all there. Can be done quite cheaply.
You're also involved on the ground, right, with establishing local community banks.
Exactly.
Yeah. Any results from your projects already?
Well, yes, we're already lending to small firms, and it's quite clear this is very positive. Also, under stress like this COVID situation, it's clear that this has been very beneficial. I am involved in establishing the Hampshire Community Bank as a sort of first community bank according to this model that focuses on small firms, lending to small firms, SMEs that have productive investment. It's a very robust model. In many ways, you could say it's just traditional banking on a local scale that doesn't want to become a mega bank. So there's no aspiration to become a huge bank. It'll stay local. It'll focus on its job.
In touch with the real economy.
Exactly.
Right?
In touch and actually knowing your customers and being in touch there. And we're showing to the regulators that this is viable. It's commercially viable. As a business model, it's viable. And to achieve all the goals. And I think it ticks all the boxes. So the regulators have been coming round. We've been engaged with them for several years. And we've gone through the challenge session now successfully. And we now need to, hand in the final application. So, we do hope they will also reflect on the benefits this will bring to the economy. And well, they just need to analyze our business model. I think it's quite robust. It's a robust business. It is a profitable business model. Yes.
Yeah. Great. Thank you so much, Mr. Werner. Hope we can stay in touch.
Thank you very much. Thanks. Thank you very much. I appreciate it. Thanks for your time.